Well, hello, everyone. Cynthia Tomaine with Interactive Brokers, and thank you for joining us today as we take a look at modeling strategies of investing grades. Now, with us today, I'm very pleased to have John Reese. John is the founder and CEO of Validea, as well as an author of the Guru Investor, How to Beat the Market Using History's Best Investment Strategies. Now, John's also a regular columnist for Real Money, Forbes, and Canada's Globe and Mail. He's also the co-founder of Validea Capital Management, a money management firm for high net worth individuals and institutions, and advises on an actively managed ETF. John's a graduate of MIT and also holds an MBA from Harvard Business School. So please join me in welcoming John Reese, our speaker for today. John, I'm going to go ahead and put this over on your slides and pass you the ball so that we can get started. If you can unmute your phone, let's get underway today. Thanks for joining us, John.
Cynthia, thank you very much for the introduction. I'm going to assume that most of you who are listening to this have read one or possibly several books by the legendary investors themselves or about the legendary investors and have an interest in them and modeling them. I'm going to also assume that you also have some interest in understanding what type of ratios that a number of gurus use to find successful. I know that in my investing career, I always had those questions, and part of trying to answer that resulted in these guru strategies. The goal of today's presentation is I'm going to share with you some of the fundamental stock selection strategies of two legendary value investors, both Benjamin Graham and Warren Buffett. So in total, we actually run a total of 22 strategies, of which we make 12 available publicly on our website, Validea.com. I'm going to also share with you what I consider 5 keys to success that I've learned over my investing career. And we're actually going to look at some of the actual tools that you'll find useful on Validea.com, which is a research site that utilizes those models. And we'll actually show you a way of screening stocks using some of the criteria that we've talked about today. My background begins at MIT, where I was part of the Artificial Intelligence Laboratory. And that was significant because my key project that I worked on at that time was to translate knowledge and wisdom from books into a computer program. In other words, making the computer program smart so it could act like a human. And as you'll see, I utilized that technique much later on in my career in terms of what we're talking about today. I then became an engineer, went on to Harvard Business School, and this was at the very beginning of the personal computer industry, worked in technology marketing on the very original personal computers, then went into telecommunications, then founded my own technology business and local area networking, and after 9 years sold that off to GE Capital. So at that point, I was looking for my own ways to invest money in the stock market, and I had always had that fascination from a kid. And I started doing research in the markets and looking at newsletters, looking at magazines, trying to figure out who can I follow that has the best advice. Who, if they give me advice now, if I follow them, will I be successful for years in the future? After a great deal of study, I came across a particular book, Peter Lynch's One Up on Wall Street, that provided the inspiration for what came later. So here was somebody with a fantastic track record of having grown his mutual funds to the largest in the world at that time, who was able to articulate his strategy in picking stocks that made him successful. And, very importantly, he was detailed enough in his description that I could actually take that information from his book and implement it in a computer program. Many times authors of books are not sufficiently clear that you can actually do that, but Peter Lynch actually was. So I implemented that first in a spreadsheet. That proved successful, then tied that to a database so I could save myself hours of time of researching the meticulous amount of data that was required and come up with a decision that the guru would have a strong interest in it, a some interest, or no interest in the stock at that time, and furthermore could actually tell me why. I started publishing that information on the internet as Validea.com, and granted a patent on the technology, and then in 2003 developed model portfolios based upon the selection of these guru criteria. I went on to several other gurus, and I'll be explaining who those are in a moment. But the key thing was the model portfolios allowed us to track basically in real time the decisions that these models would make and what their performance are. That was actually quite successful, and after a couple of years, enough of my subscribers asked me to manage their money for them, and that resulted in forming a registered investment advisory, Validea Capital Management. That then grew over a few years. It attracted the National Bank of Canada to ask me to sub-advise 2 mutual funds for them. And those have gone on to do quite well, one of which is actually a 4-star Morningstar fund. And then finally, a little over a year ago, founded a ETF based upon these particular strategies. So in total, I'm managing about $650 million on my guru-based portfolios. So who are some of these people that we follow? I mentioned Peter Lynch. He's a growth as a value manager, and basically had run his mutual fund to become the very biggest at the time, the Magellan Fund. Benjamin Graham is widely credited as being the father of value investing. He was also the professor of Warren Buffett. Wrote the book, The Intelligent Investor, and I modeled my strategies based upon what he did. Warren Buffett, as it requires almost no induction, basically the first, second, or third richest person in the world at this time, and has undergone a transformation. He himself has not written a specific book about how he does his investing, although some general principles, of course, that he's written in his annual letters. But the best research that I've read about him is from his ex-daughter-in-law, Mary Buffett, who wrote the book Buffettology, upon which I base the Buffett strategy. Ken Fisher, very famed money manager for columnist and professional investor, has gone on to manage about $35 billion at this time. His formulary was based upon popularizing the price-to-sales ratio. He was the first person to essentially do that. David Dremen, considered the great contrarian investor, also manager of mutual funds. Martin Zweig, very famous growth investor, appeared on Wall Street Week, and according to Harvard Digest, had the #1 rated performance for risk-adjusted performance over a 15-year period of time. He wrote the book Winning on Wall Street, excellent book for growth stock investing. James O'Shaughnessy, famed money manager, also famous author, wrote the book What Works on Wall Street. Basically, he did a seminal study, 45 years of what works, what ratios work on investing in Wall Street. John Nepp, the famed manager of the Windsor Fund. Joel Greenblatt, a famed hedge fund manager. He has written one of the simplest strategies, but also one very effective. Somebody little known, Joseph Piotrowski, is an accounting professor at Stanford. And it's well known in academics that price-to-book strategies can beat the market over the long term. Piotrowski then asked, well, is there a way of separating the wheat from the chaff when using that? Is there a way of judging those companies that that meet the price-to-book criteria that are less likely to fail? And he came up with a number of criteria that could reduce the probability that a company would fail. And finally, William O'Neill, the founder of Investors Business Daily and author of the CanSlim system for momentum investing. So why these gurus? So there are three key reasons. One, each has a long-term record of outperforming the market, so there was a track record. Second, they publicly disclose those particular techniques, and they've done that in books or other sources or academic papers. And third, there had to be a strong portion of which was a quantitative methodology that can be leveraged using a computer program. Again, it isn't sufficient if somebody says, buy low PE stocks. How low is low? And what earnings you use in the price-to-earnings ratio. For instance, as we'll discuss later, while price-to-earnings based on the trailing 12 months is popular, Benjamin Graham actually used the average of earnings over the past 3 years. So somebody had to be explicit enough in their descriptions in order to actually be implemented and followed. With that, let's turn to look at the quantitative strategy of legendary investor Benjamin Graham. Step one in his procedure is that he first looked at the sector and he actually rejected technology stocks. So technology stocks fail, all of the stocks would pass, including public utilities. He also required a minimum size of the company, and he did that in terms of the sales of the company. Adjusted for inflation, because this was over 40 years ago that he actually wrote his book, the companies today have to be at least $340 million in sales in order to be part of his selection criteria. Second was the current ratio, something that a lot of accountants use. If the current ratio is greater than 2, which is considered pretty conservative by most CPAs, then it passes. If the current ratio is less than 2, he would give an exception if the company was a utility or telecom because they were regulated and therefore able to generate and cover their cash flow. But if the current ratio is less than 2, he basically failed that particular company. Long-term debt in relation to net current assets. So basically, he wanted to see that long-term debt of the company could be paid off using net current assets, that is the cash minus the immediate cash liabilities plus the inventory of the firm had to be able to pay off the long-term debt. This is a very severe requirement that it is difficult for many companies to actually meet. Long-term EPS growth. He wanted to see that the company had a bias, a slight bias toward growth. Now, he's not looking for exceptional growth rate. In fact, if anything, he's looking for a very modest growth rate. He wanted to see that over a 10-year period of time that the company had grown at least 30% and that there were no negative earnings per shares in the last 5 years. That translates to less than a 3% growth rate. So again, he wasn't looking for a fast-growing firm, but he wanted to see a bias over a long period of time that there was still some growth in the company's earnings. Price-to-earnings ratio. As I was mentioning earlier, he is unusual in that he wants earnings to be the average of the last 3 years of earnings of the company in calculating the price-to-earnings ratio. And he also wanted to be relatively small, less than or equal to 15. But that wasn't the only really strict value criteria that he used. He used the price-to-book ratio. And he didn't just use it as an ordinary criteria, but he multiplied the price-to-book ratio times the price-to-earnings ratio, and he wanted the product of those to be less than 22. So therefore, if the price-to-earnings ratio was already 15, the price-to-book ratio could be no more than 1.46 in order to pass. Again, these are pretty tough criteria. Most companies can't make these criteria. They're too pricey by his methodology. Total debt-to-equity ratio. So we've already had one debt-to-equity ratio criteria, but another one he wanted to see was in industrial companies. He wanted to see debt-to-equity of less than 100%. He would make exceptions for utilities, phone companies, and railroads, where the debt-to-equity ratio, that is specifically the long-term debt, could be as much as 230%. So how has the Graham portfolio, the value investor model that we based on him, actually done? And going back to 2003, which is the time that we started tracking these models going on a forward basis, so this is not back testing but going forward, the portfolio returned almost 270%, and that outperformed the S&P 500 by 163% over that time, using what we consider its optimal rebalancing method. This is based on a 10-stock portfolio that meets his criteria. You'll see in the chart here the outperformance over a long period of time. What are some of the stocks that are in the portfolio today top rated? You can see United Natural Foods, Westlake Chemicals, Dillard's, Sasol, an oil company, jumping down, Waddell & Reed, the financial company, Tech Data Company. All of these meet his criteria, and this is a page actually drawn from the Validea.com website, so you can see what's actually in a portfolio and see fundamental data about them. So let's spend a little time looking at the quantitative strategy of Warren Buffett. So a number of people consider him the greatest guru. First step in his methodology is to ask, is this even a Buffett-type company? So what does that mean? The nature of the firm's business, is it a leader in its industry? Does it have ability to pass on costs? Is its business model more simple than complex? These are actually qualitative questions that must be answered for companies as compared to quantitative. But frequently, companies with strong regional brands can pass, or national brands, or very simplistic. And only recently has started even investing in technology companies such as IBM, where they are a leader in the industry. Second criteria looks at the earnings predictability. Alone among all the gurus, and I find this very interesting, he wants to see 10 years worth of earnings. Many of the other gurus look at last year's earnings, or 3 years, or 5 years of earnings, but alone among the gurus, he wants to see a trend of 12 years worth of earnings, where it's each year it's equal to or going up. Very few companies in the stock market actually pass this. Now, he has a couple of exceptions based upon companies he's actually bought, and that is he has allowed for dips from prior year's earnings where over a 10-year period of time it's totaled no more than 45%. So if, 1 year, 9 years ago, it dropped by 25%, then went on to set new highs, and then a few years ago it dropped by another 25%, and then it's gone on to set new highs, that would actually disqualify the company. What is actually happening here is actually very, very important to his strategy. He is getting companies with earnings predictability over a long period of time, and this becomes exceptionally important to his strategic criteria, as I will mention later on as part of this. So again, he's looked over a 10-year period of time and looking for continually increasing earnings with dips totaling no more than 45% over that period of time. And the dip could be in the most recent year, because usually that's a good indication that that's actually a bargain buying opportunity. Long-term debt. He is also unusual in that rather than using debt to equity, he wanted to see that the long-term debt could be paid off by the earnings of the company. So if the earnings of the company could be paid off, or if the debt of the company could be paid off with less than 5 years worth of earnings, that would be an acceptable criterion. Less than 5 years worth of earnings, he would fail the company and not be interested. And if the debt could be paid off with less than 2 years worth of earnings from the company, that would be the best case and would be very exciting. He looked for return on equity, not just for 1 year, but again over a full 10 years of the company, and wanted to see that the average return on equity was greater than or equal to 15%. Return on capital. It wasn't enough that the return on equity had to be 15%, but many companies can goose up their performance by borrowing a lot of money. So return on total capital includes both the equity and the borrowed debt of the company, and he wanted to see that the return over a 10-year period of time per year was greater than or equal to 12%. Capital expenditures. One of the things that he's well known for is that in the companies he's invested in over the period of time that he became the most successful, basically he wanted to see that the capital expenditures of the company could be financed from all of the free cash flow from the company. So in other words, the company would not have to borrow in order to make its normal expenditures for capital improvements and acquisitions. Utilization of retained earnings. One of the explicit ways that he judged the quality of the management of the firm was if the earnings that they kept over the past 10 years, so each year they pay some back to in dividends to the stockholders and they retain the rest of the earnings, were they able to obtain at least a 12% or 15% return on the money that they kept back in the company? This is, again, the way he judged the efficiency of the management of a company. Even after all of those criteria were passed by a company, it didn't stop there in terms of his analysis. He wanted to know, is the price right at this time to actually accumulate the company? And he did that in two different ways. He calculated a return using the return on earnings criteria, so he was actually able to project that 10 years into the future. He also used a projected earnings per share method, again, projecting the growth of the company 10 years into the future, and then averaging those out. Now, with most ordinary investing strategies, if you try to project 5 or 10 years in the future, it's almost ridiculous or laughable in terms of the accuracy with which you have. But this goes back to the very first criteria that he had. He was different in that he wanted to see that the earnings of the company were relatively or highly predictable. And that is one of the key strengths of his methodology here, and that comes to his benefit and sets this particular methodology apart. So he wanted to see 15%. In some of his investments, he accepted at least 12%, but generally wanted to see a 15% or more expected average return. So if we wanted to see the I should say, wanted to see the portfolio results of this. This portfolio has actually returned 136% compared to the market, so it actually outperformed the market by 42% using monthly rebalancing and a 10-stock portfolio size. And in the dark blue, you can see the outperformance of the strategy over the S&P 500. Some of the stocks that are held in the portfolio right now, World Acceptance Corporation for consumer borrowing. Apple, interestingly enough, has come into portfolio with steady projections, and with the recent doubts in Apple in terms of its sales, that's created an opportunity where the price is attractive compared to the risk of the company, yet it passes all his other criteria. It's interesting that the earnings of the company, again, have met this strongly earnings predictable criteria over the past 10 years. FactSet is a long-term holding of his. Ross Stores and TJX. Interestingly enough, you see strong retailers. Again, it's very interesting, but strong predictable earnings over a long period of time. So here's a question. Once strategies become well-known, there's this perception or thought that you can't take advantages of strategies anymore. So we've got to ask the question, do these girl strategies still work today? And the answer actually is a resounding yes. And to give you a little background, I want to repeat that I've been running these guru models in real time since 2003. So these are based upon actual selections of the models, now more than 12 years of actual historical data in terms of what they traded. This lists all of the strategies and the what we call the optimal portfolios. We allow each user of the site to select whether they prefer to rebalance annually or quarterly or monthly, depending upon their trading frequently, and whether they want to diversify into a 10-stock or 20-stock portfolio. But the number one right now is actually based on the Motley Full portfolio, the small cap growth investing style of investing. And its return, if you'll essentially notice over this, let me get a pointer here. Basically is 440%, which is 334% over the S&P 500 return over that period of time. In number two place is actually the Peter Lynch strategy, again growing more than 200% over the S&P 500 over that period of time. And these statistics are available on the website and kept updated for those people who are interested in following this. We also use what are known as consensus strategies. Basically, we have different ways of combining our guru portfolio strategies, one of which is we call our top five, and that is we take the top 5 guru strategies and each selects 2 stocks from the top strategy, and we create a portfolio based on that. We also have what we call the Validea hot list, which actually is a consensus-weighted system. It uses all 22 of the strategies and weights the vote of each strategy based upon the risk-adjusted performance since we've been tracking, and gives a selection of the top 10 stocks. In the top 5 guru strategies, you'll see that the annual return is 10.6%, which is also almost double the S&P 500 return of 5.8%. The hot list has done almost as well, again, 8.4% compounded over this period of time versus 5.8% per year for the S&P 500. I do want to importantly, in fairness, call your attention to the volatility of these strategies. They are more volatile than the S&P 500 to get the outperformance, and you can also see most recently in the top 5, the performance has fallen off. Now, performance has fallen off before. That's not necessarily a big cause for concern, but I want people to know that when you go for a strategy, it's important to stick for the strategy for the long term. And it's interesting, but when the strategy performance goes down, you could be a contrarian. It could be actually a good time to invest in it. I'm going to share with you our 5 keys that we've learned are important for successful investing over long periods of term. And this comes from research that we've done. It comes from understanding investor behavior. One of the first things that's important is to think long term. In all of the investing that we've done, basically the long-term investor generally comes out ahead. The market itself is risky and uncertain in the short term. There have been 50% declines in the S&P 500 4 times throughout history, of which 2 times have been in the last 15 years. So it turns out, though, that the odds are in your favor if you take a long-term view. This is important for those of you who are over 65 years old. You really still have to make your money grow for another 20 to 25 years. So we found that taking a long-term view is the best approach. Be unemotional and disciplined. This is very easy to say, very hard to do, but a Dauber study showed that over the last 20 years, the S&P 500 returned 9.2% compounded, at least for the date of the study, compared to just 5% across all investors. And why is that? Because investors become very concerned about recent drops in the markets. They're usually overly optimistic to begin with in terms of their ability to find and select the particular stocks. They have a recency bias toward what is happening in the market is going to continue to happen, and they have a loss aversion, and that is very painful to lose money, and the fear of losing money causes them to act out of proportion to understanding that the long-term trends of the market are up, that 2 out of 3 years, the market is up, not down. But this tremendously hurts the individual investor in terms of their the biases in terms of the performance, and that's why we say that remove the emotion and be disciplined in your investing. Know your true risk tolerance. All good stock strategies can experience large declines. So let me talk about that just a second, because again, that sounds like a truism, but I've been researching what are the most successful strategies now for more than 15 years. And every time I think I found the Holy Grail, I found strategies that could undergo periods of underperformance. And it's necessary to stick through those strategies through thick and thin, given that they have a long-term track record to begin with. If you don't have a long-term track record, then I'm not advising that you necessarily stick with a failing strategy. But when the strategies are based upon long-term track record, it's important that you be able to stick with it and go through the loss, because the loss is not permanent until you sell out. But in general, in terms of your temperament, if you cannot handle a 40% decline unemotionally in the stock market, you really should not be fully invested in stocks. Time after time, I find new investors come to me, and they're not prepared for the average drop in the market that you're going to encounter as a long-term investor in the market. And as a result, many times they want to sell out near the low of the market and not hold on. But each time you've seen these 50% drops in the market, they've been great buying opportunities, not great selling opportunities. So stocks actually recover from losses relatively quickly. Stocks took just 22 months to recover all losses once the market bottomed from the most recent downturn, just in March of 2009. I don't think many people actually realized it was that quick. Of course, you want to take advantage of the only free lunch in investing, which is diversify your portfolio, both in the number of stocks and across different asset categories, realizing, though, that when market crunches come, you may have less diversification than you thought. But nevertheless, during most of the time, you should be taking advantage of diversifying among a number of securities. And downside volatility can certainly be your friend if you're adding to your portfolio as the markets become cheaper or actually go down. Joel Greenblatt did a study in his book, The Little Book That Beats the Market. He examined how often his successful strategy actually underperformed the market for periods of time. And this is very instructive to really hit home what I mean. His really excellent performing strategy underperformed the market on 1 year periods of time 25% of the time. There were 2 year periods when he underperformed the market 17% of the time this actually happened. But finally, by 3 year periods of time, it outperformed the market by 95% of the time. So even in some of the most successful strategies, you will have down years within the market. And a key message that I'm trying to share with you is that once you've identified the successful strategy, you need to stick with the successful strategy through the downturn and not abandon it in the middle. 6 is fundamentals. It's very interesting, but in my study of who the successful long-term gurus essentially are, I did not find any that were purely technical investors. I did find some that uses some technical investing techniques such as relative strength in part of their formulas, but for the most part it was not based on price and volume movements or charting patterns. It was based upon the fundamentals, the earnings per share, the accounting, the debt, all of those things, fundamentals, were the common thread of the investors. You also want to avoid based upon the current headlines, investing based on the current headlines. Drummond did a study of 11 crises post-World War II, and he found that the market was up on average by 25% 1 year after the crisis. What are we talking? The Gulf War, the Korean War, long-term capital management. So these things received huge headlines in the day, spooking lots of investors. But in the end, the market was up hugely 1 year after that crisis. Take September 11th, 2001. It took just 1 month for the S&P 500 to climb back up to pre-September 11th levels. Ken Fisher did a study. He found that only once in history had a war or conflict actually stopped the bull market. Think about that. And that was 1938, just before World War II. And then Phil Tetlock did a study analyzing the accuracy of experts. He studied over 80,000 predictions of experts, and what he found was that experts were right no more than 20% of the time. 1 in 5 experts. So when other people or I get on TV and I say that such and such a stock is going to go up, or the Dow Jones is going to be higher a year from now than it is right now, basically I as an expert have only a 1 in 5 chance of actually being right about that. This is astounding, and I've myself have done studies. I've looked at the confidence factor of the experts. I've looked at the amount or the number of reasons they have supporting it. I've looked at whether they're predicting good things or basically bad things. They're predicting stocks to go up and they're predicting stocks to go down. None of that has a correlation at all in terms of the accuracy of that particular prediction. It turns out that simple computer models actually have a much higher % chance of accuracy than the experts that you're seeing on CNBC actually do. Understand the strategy and have conviction in it. So the more you understand the strategy and the details behind it, the better off you'll be, because you'll be able to go through the good and bad periods of performance and stick with those and stick with any underperforming short-term periods of time. With that, I'd like to share with you a quote that I really like from Buffett on emotions discipline. He said, investing is not a game where the guy with a 160 IQ beats the guy with a 130 IQ. Once you have ordinary intelligence, what you need is a temperament to control the urges that get the other people into trouble in investing. He also said, to invest successfully does not require a stratospheric IQ, unusual business insights, or inside information. What's needed is a sound intellectual framework for making decisions and the ability to keep emotions from corroding the framework. So I underline the keep emotions from corroding the framework, because that's what I've shown you today. I've shown you a framework for actually making non-emotional decisions for picking stocks in the stock market. What are some of the tools that you can actually use to do that? So first, be aware that through interactive brokers in their research platform, it is possible for you to subscribe to Validea reports on a number of stocks and see in-depth reports by the gurus updated once every 2 weeks for an analysis, step-by-step, showing why or why not they actually pass the guru strategy. But I'm actually going to show you in more detail one of these reports available on the website here. I'm going to switch to my web browser. Let's just take a particular stock like Cal-Maine Foods, ticker symbol CALM. one of the things by using the Validea.com subscription site is that you can get a quick overview by each of our strategies of their interest in the particular stock. You can see the score. 80% or above is what you really want to see for an interest in the stock. And then furthermore, it's possible to click in very simply. I'm going to click here on the Peter Lynch and actually see the detailed GRU analysis. First, some reports on the report card on the fundamentals, but a quick summary. This is a report card by each of the key ratios that he uses, and then really more important and more valuable is the detailed analysis. I'm scrolling down here that Lynch looks into 3 different strategies. He characterizes this particular stock as a fast grower. Then he applies certain criteria based upon that, including a PEG ratio, sales and PE ratio, inventory to sales, so on and so forth. And then finally coming to the conclusion that there is a strong interest in this particular stock. You may be interested, for instance, Facebook. And you can see, again, a quick overall summary by each individual strategy, what are interested or not interested in Facebook at the moment. And it's then possible to see, let's say, by the Motley Fool strategy, which particular criteria and analysis that this particular stock passes or fails, including a detailed analysis. This is really, really very insightful. Second thing that you can see on the actual site itself is the portfolios. You can find out which are the portfolios that are doing best over long periods of time. Here you can see the Motley Fool strategy is returning on an annualized basis 14% per year since 2003 versus just 5.9% for the S&P 509. That's an outperformance of 8.1% per year averaged and annualized over that period of time. And if you're interested in finding out whether it's quarterly or monthly or annual rebalancing, you can do that too for these particular portfolios. Again, you can see the portfolio performance for any of these that you want to follow. The Growth Investor by Martin Zweig. It's interesting, but when we looked at Facebook, I saw very quickly that it was the growth and momentum strategies that were most favorable toward Facebook at the current time. The Growth Investor, which is one of the great strategies by Martin Zweig, here's his outperformance over the period of time since 2003. And finally, one other tool that I find very interesting for most individual investors is you're able to choose a guru, let's say like Warren Buffett, and say I'm interested in stocks he would find is strong with some interest now. And then you're able to add criteria such as, let's say we want large cap stocks, market cap, we want it to be 10 billion and above. We can add that, and the list is immediately regenerated. And let's add another fundamental, such as the dividend yield, and we want it to be at least equal to the market of 2%, but we really don't want it to be higher than 7%, which would tend to indicate more often than not that the stock is in danger of an earnings collapse or not being able to make its dividend payments and therefore could fall. So to be conservative, you might put an upper cap of 7% on that. And we're able to find out very quickly the number of stocks that meet this. Interestingly enough, Apple scores 100% on the Benjamin Graham strategy, market cap of $500 billion, price-to-earnings ratio of 10, and still has a dividend yield of 2.4%. So that allows you a huge amount of flexibility when you have ideas of particularly stocks. You can start with fundamentally sound guru stocks and then add your criteria that you need for your preferences in terms of how you go about picking stocks. So with that, I am going to turn this back to Cynthia, and I am also available to take questions. In fact, if you do have questions, you can type it into the particular chat box right now, and I will answer them.
Okay, well, thank you very much, John. And while I see a couple of questions have come in, and also I do want to take, while we're waiting for any additional questions, I've taken the ball back because, as you mentioned, Validea is available on the Interactive Broker platform. Now, let's move. I'm going to do, okay, I do have control. I'm going to go right into a desktop share so that we can see where you can access the information. Now, I'm a little bit ahead of myself here. I'm going to cancel this out. But I did want to show everyone that you can actually access the information from the Trader Workstation. Now, first, you will need to subscribe, and you can do so from the account management feature, and I do already have account management opened up. Notice that from our Manage Account section, there is a trade configuration if you scroll down to there, and then go into the Research feature. Now, Research, you'll be able to find our information system with the available research that you can subscribe to. I'm going to scroll down the page. You'll find news providers appear up on top, but also notice here Validea is one of those that is listed. You can get those guru stock reports and ratings directly in your Interactive Broker Trader Workstation account. Now, once you do subscribe, there is a free trial, by the way. You simply put a check mark in front of that box. But once you have subscribed, let's jump over into the Trader Workstation where you can access that feature. Notice I'm going to be working in Mosaic, and whether you're using the pre-formatted Mosaic workspace or the classic PWS spreadsheet layout, you can get to those analyst providers simply clicking the button that appears up at the top of your screen. Notice here where you do have access, those you've subscribed to will appear on top. There's additional features that are available. And simply coming into this window, you'll find the analysis reports are available. Now, you can scroll through any of these reports or notice, and what I'm going to do is bring up that same ticker John had just mentioned, CALM. And notice here, let's see, it should populate within this window. Oh, it helps if you spell it correctly. My fingers got ahead of me here, so I'll go ahead and make that. And notice here is that report. So simply clicking that report will take you right into their stock report that's available. So I wanted to point that out if you do subscribe. And by the way, there is a 30-day free trial period if you'd like to take a look at it. I'm going to minimize this here because there were a couple of other things that I did want to mention to you. And a relatively new feature that we have available is our Portfolio Builder. Notice Portfolio Builder is a research-driven platform here. Now, I'm not going to go through the basics, but I did want you to know that Validea is actually a part of the Portfolio Builder. Notice that when I go into edit the investment rules, and I've got a hypothetical portfolio, I did want to take you down to notice that you can sort all of the stocks by analyst ratings. And as I move in here, one of those 11 providers is Validea. So where it's available, you can actually pull up certain parameters through our Portfolio Builder using the Validea research platform. So did want to make you aware of that. Before I jump out of here, I also want to take a look. I'm going to minimize this. Let's just close out of this window, and I'll minimize this. But also do be aware, if you happen to be a classic PWS user, you can go into the Analytical Tools menu item and down to Analyst Research, and you'll be able to access that very same information. So whether you're a classic user or our Mosaic feature, you can access the information on the platform. Now, also, while I'm still sharing my account or sharing my desktop, I do want to take just a moment to take you to the Interactive Broker platform. Today's event is being recorded, and you can access today's information later on this afternoon as soon as I get it compiled and uploaded to our servers. Underneath the Education menu, there's a Webinars link. From here, you can view any of our upcoming webinars or come out and view any of our recorded sessions. Now, notice here that once you move into this page, we do have several tabs that are included up at the top of the screen. Jumping into the Industry Sponsored page is where you'll find today's event. By the way, for having registered, you'll automatically get a direct link to today's playback, just in case you do want to come back and review any of the concepts that we've discussed here today. So what I'm going to do is take a moment right now. Let's stop the sharing and get back into our main event window. Now, I do want to mention, before I turn this back over to John to handle any of those questions, you'll see that he's included several different links on his presentation. This presentation has been or will appear as you exit today's session. It's in PDF format, so you can view or even download and print directly from the browser window where you'll see today's webinar notes. But also be aware that any of the links that he's provided will be active in that PDF, so you can go out and review the information as well from Validea's website. So, John, I've been talking for a few minutes here. Have you had a chance to take a look at those questions?
I have indeed.
Okay. Well, I'll send this back over to you then.
Okay. So, first question is, what happens if we think long, but with stop loss we sell stocks and we buy only when we think it's going up? That way, the only loss on commissions, and you keep stock only if it's going up while increasing the stop loss every time to assure the earnings. Is that a good strategy? I will say we have not particularly tested that specific strategy. We have tested a number of stop losses, everything from very narrow stop losses, 2 or 5% to 10%, 15%, up to wide stop losses, 20 and 30%. What we have found, very interestingly enough, is that it is neutral. It does not save money or make money to put in the stop losses. That actually surprised us, but we found that basically it was about equal half the time, wherever we place a stop, that the stock would return and go on to new high levels as compared to going down. So the actual stop loss is part of this. We ourselves generally will keep a very wide stop loss, like 40% on it, but we find that keeping just a flat or particular stop loss does not improve or subtract from overall performance. We've not tried or tested out or researched a trailing stop loss, which the question there was actually asking about, to see if that can make a particular difference. I do suspect, though, that buying when the stock is going up could actually be a valuable strategy, but at the same time, I have to say we've also tested buying on dips also works. So when the stock is going down, which is contrary to the actual question. We were asked, are you hedging your portfolios in any way? And the answer is no. They are non-hedged portfolios. They maintain full investment. They're usually, let's say, a 10-stock portfolio. Each stock is equally weighted in it, and when the rebalancing day comes, whether it's on a monthly, quarterly, or annual basis, whatever you pre-decided you want to update your portfolio with the latest information, we unceremoniously will remove any stock in it, regardless if we like that stock or not. We'll unceremoniously take it out of the portfolio and replace it with a higher scoring stock according to that guru strategy. But it remains a unhedged portfolio. Do the portfolio return statistics, quote, include transaction costs? And the answer is no. In this particular portion, it is not. Now, transaction costs, depending on portfolio, should be well under 1%, could even be a 0.5% or less, buying and selling, unless we're talking about very small portfolio sizes. So transaction costs used to be a pretty big number. When I first started in this industry, it could cost 2% to enter your position and 2% to exit your position, and that was even if you were a big-size investors. Nowadays, with discount brokers like IB, it's almost insignificant in terms of the transaction cost, and with the digitization of prices, the slippage that you incur is also pretty minimal in terms of percentage cost. So no, it does not include the transaction cost. This person wanted to know, do we sort by liquidity and market cap? When we actually invest in portfolios, there are minimum liquidity requirements that we have and market cap. When we display our presentations of stocks, it is possible to click on the column heading and actually display the largest through smallest market caps. Each guru criteria has its own requirement for market caps that we adhere to. They may have some liquidity requirements, but for the most part, we like to see at least stocks that have $100 million or more of in terms of the market cap size, and liquidity. We usually like to see 4 million or more in terms of daily dollar volume for trading. How does the monthly rebalancing process work? What happens when you have 30 other stocks that meet the criteria but are only willing to hold a portfolio of 20 in the portfolio? That's actually a good question. So in the rebalancing process, all the stocks are scored by the guru. So there are several thousand stocks, each receive a guru score, and it's possible that several are tied. What we use to resolve the ties is that we look at the other guru models, and we see which have the highest number of preference among other guru models, and therefore it's a bias, positive bias, if it actually passes more than one other model at a time, and that's how we actually use a tie reduction. So if there are multiple strategies in the market that like it, we weight that higher, and that breaks the tie. And then you just go through your maximum number of stocks. The 10 stocks you purchase are similar valued, or just one $100 and another $20, or you split them like $1,000 each? No, that again goes back to equal balancing. So let's just say if you have a $100,000 portfolio, that means that at rebalancing time, you strive to have about $10,000 in each stock, or equal weighted. If there's a very small difference in percentage, like something has 11,000 in it, you won't rebalance or sell the portfolio at that time. You allow that to float, but generally striving the positions are equal weighted, not and therefore you adjust the number of shares to make that equal weighted. How are the strategies doing during 2016? After multiple years of value underperforming growth, we've seen a snapback in terms of some of our deepest value strategies. The portfolio is based on Graham and David Dremen and Joseph Pietrossi, which had difficult years in 2015, have shown a very nice rebound this year, 2016. So we think that value approaches, particularly the ones that focus on smaller cap names, have a high probability of producing relative outperformance over the market over the next few years. And I see that we have just done toward the end of the hour. So with that, I guess we will conclude our Q&A.
Okay, well actually, John, I did get a question that was directed at IB, wondering if options are available on stocks on the IB platform. And Allie, yes they are. There is a selection in your global configuration window. If you click on any of those wrench icons that you see, open up global configuration, and in the display section, there's a ticker row where you can activate. There's a simple checkbox where you can tell TWS to display all of the option or all of the stocks that have associated option contracts in bold. So wherever you have those stocks appearing in any of your watch lists, you'll be able to distinguish which ones have options available and which ones don't. So remember, that's global config, display, ticker row settings. Well, with that, I want to thank John Reese very much. John, excellent presentation here today. Thank you for joining us, and I want to remind you that we have been recording. So if you do want to come back and revisit what John discussed, or simply go back into the notes, watch for the webinar notes that pop up as you do exit today's session. Now, I do have one piece of business before you do exit today's event, and that's to run a poll. IB's management requires that I do this in each event, so notice I'm going to open up a polling panel on your screen. There are 3 short questions. We try and make this quick. And then once you make your selection, do click the Submit button in the lower right-hand corner. By the way, there's an input field there. If you've got any suggestions for other webinars, it makes a great place to put them. But I do want, poll's going to end, so please click the Submit button now. Those suggestions can also be sent to me at the email address, webinars@interactivebrokers.com. Poll did end, everyone, and thank you so much for today's session. And once again, thanks to John Reese of Validea. Do take a look at our portfolio builder for individual traders, or the model portfolio, which are both features that you can utilize John's suggestions today through the Interactive Broker platform. So that is going to conclude our event today. Have a great day, everyone, and please remember to trade smart. Thank you.